Good afternoon. For those of you who are in Stockholm, good morning if you are in New York or in Chicago. Very welcome to this event organized by the Swedish House of Finance at the Stockholm School of Economics. My name is Magnus Dahlquist, and I'm a professor of finance at the school and on the faculty here. So, today, Professor Stijn Van Nieuwerburgh will give a talk on how will the COVID pandemic reshape residential and commercial property markets. Before we move into the program, I would like to inform you that the event will be recorded and we will finish at 5:45 at the very latest. To begin, I would like to give the word to Kajsa Lindstål, who is the chair of the Thule Foundation. Over to you, Kajsa.
Thank you. The Scandia Award is financed by the Thule Foundation, and the foundation wants to increase and encourage research on long-term savings. We also provide bachelor and master thesis awards, and in cooperation with two foundations within Scandia, we provide postgraduate scholarships. We would have preferred to welcome you to Stockholm, but the situation with the restrictions around the pandemic, the COVID-19, made it rather difficult. And it's a very grey and rainy day here in Stockholm, so you don't miss anything, I promise you. I want to read the motivation of the prize. Professor Stijn Van Nieuwerburgh is the recipient of Scandia's 2021 Research Award on long-term savings for his contributions regarding banking, insurance, and financial services. His research covers, among other things, residential and commercial property markets, an extremely relevant topic in these pandemic times. We have already sent you flowers. I hope they have reached you. We are going to send you the prize sum of 10,000 euro, and we have a beautiful handmade diploma, looks like this, signed by all the whole board of the foundation. And our warmest congratulations, and we're looking forward to your upcoming speech. And I want you to, Magnus and I can applaud you. Congratulations, and then I hand over to you, Magnus.
Okay. Thank you, Kajsa, and well deserved. Stijn will soon present his research, but first I would like to engage you all by asking 4 questions related to his talk. We are simply curious about your views on the real estate market. We will use the polls inside Zoom, and the starting point for this poll is that Stijn and his co-authors have shown that the pandemic-triggered urban flight has benefited the suburban real estate sector. Based on that, we would like to ask you 4 questions. Question 1, going forward, how often do you expect to work from home? And you have several options and you choose one of them. And here are the answers. And we see that there is a distribution, and 36% have said that they will expect to work 2 days per week from home. Let's move to the second question. So the question is, are you considering moving, or have you already moved in the last year from an urban to a suburban location? And you can say yes or no. So it seems like 15% has moved or considering moving. Let's move to question 3. Do you think the pandemic-induced market effects are temporary or permanent? And interesting, it seems like there's almost a tie between temporary and permanent. Let's move to the final question. In which sectors do you think the effects are the greatest? And here you have multiple choices, so you can check more than one alternative. And here are the answers. It seems like several of you think that the effects are the greatest for offices and for the retail sector, and then it's followed by hospitality and apartments. So we close the poll, and we hope that we can get further answers from Stijn on these topics. It is now my great pleasure to introduce today's speakers. Professor Stijn Van Nieuwerburgh from Columbia University. Stijn has written extensively on a wide range of topics in housing, asset pricing, and macroeconomics. I'm particularly fond of Stijn's work on return predictability in the pricing of bonds and stocks, and his most recent research on real estate finance. For example, his work analyzing the impact of foreign buyers on the housing market. Stijn's research is very inspiring, and I very much look forward to hearing about his latest findings. Stijn has about 45 minutes for his presentation, and during this presentation you can ask questions in the Q&A box. After the presentation, if time permits, we will take some questions from the box, and I will read them to Stijn. Please take the opportunity to ask about Stijn's research and views. Without further ado, I give the digital floor to Stijn, and you can share the slides.
Thank you, Magnus. First of all, I would like to thank the Thule Foundation and for receiving the Scandia Award. It's a great honor and pleasure to see work on real estate recognized by this award. As we all know, real estate is something that affects all of us, whether it's in our living environment or in our working environment, and it's really encouraging to see to see more research on this topic. And I hope that with today's talk, I can inspire some of the younger generation of researchers to take up this topic. So thank you very much again, and thank you also to Magnus and to the Swedish House of Finance for hosting this meeting today. So today I wanted to tell you a little bit about some recent work I've been doing on residential and commercial real estate during the pandemic. And as you've already answered in these poll questions, real estate was really severely affected and in many different ways that I hope to touch on today. So it's my view that COVID-19 is really one of the most profound shocks that has hit the real estate market in our lifetimes. It caused urban to suburban migration, as I will show you. It changed residential rents and house prices. It also severely affected income-producing property, commercial real estate, by disrupting the cash flows, by increasing risk premia on these assets, and by reducing liquidity. So some of these changes have faded already as the virus has slowly been brought under control and as the economy has gradually recovered. But other changes will be permanent and will be bringing about a new normal. And in particular, I'm thinking about working from home. Many of you just answered that you expected to be working from home for the foreseeable future, 1, 2, 3, or even 5 days per week. And I also think about e-commerce. So different real estate sectors, as we also saw in the real estate poll, have been affected very differently. And in the second half of today's talk, I'm going to tell you a little bit more on commercial real estate. So I would like to start by sharing some research on residential real estate, on the housing market, and document the evolution of urban and suburban house prices and rents in 2020. And then I want to ask, what can we learn from the changes in prices and rents about the future? And in particular about the recovery in the urban markets. And then I want to dig a little bit deeper into the mechanisms that were underlying the changes in prices and rents that took place last year. And I want to argue that working from home, and in particular, the ability to work somewhere that does not require commuting to the office was really the key driver behind the dynamic changes in the housing market and in the rental market that we saw last year. The second half of my talk, I want to speak about commercial real estate with a focus on the office market. I want to show you some new facts on leasing activity, on office rents, as well as on some sales data, sales transactions data on office assets. And I want to end with shedding some, hopefully some light on the evolution of prices in both private and public markets for office properties. And I want to understand a little bit to what extent, what the market's views are on the long run outlook on, rents in the office market. In other words, does the market believe that long run, because of structural changes in working from home, cash flows on office properties will be persistently depressed? Or does the market foresee a strong rebound that brings us back, in a fairly short amount of time to the situation we had before 2019? And then finally, I want to end with some speculation on the future of cities, kind of, sketching some broader implications for, the fiscal health of cities that arise from these changes in the real estate market, as well as, on the future of working from home. Okay, so that is our plan for today. Let me start by telling you a little bit about the residential market based on some work of mine with co-authors at NYU, at Columbia, as well as at Wharton. So city centers are special. We know that, and we know that cities have played a special role in urban history, in world history for a very long time, for centuries. Cities are places where there's positive productivity spillovers. People, get together with each other. They're more productive by being in close proximity to other productive people. And so in urban economics, we call these positive agglomeration effects. But cities are also special because they have a range of amenities that you cannot find elsewhere. Nice restaurants, culture, maybe attitudes towards, let's say, tolerance. If you're a single person, there's a thicker market to meet your partner. So there's all these amenities of cities. And then third, cities offer shorter commutes. By living in the city center, you likely will not need to commute nearly as far as when you live in the suburbs. You avoid congestion. You avoid potentially, bad and aging infrastructure. And so for all of these reasons, city centers are special. And so for all of these reasons, house prices and rents are higher typically in the city center than farther removed from the city center. And so we can speak about this as kind of the rent gradient or the house price gradient. It's basically the relationship between the distance from the city center and house prices and rents, right? So in Stockholm, you could think about the Royal Palace as being the core, the urban core, and then the farther you move away from the Royal Palace, the cheaper rents become, the cheaper house prices become. Right, and so this is what that relationship looks like, this urban rent gradient for New York City. And this line looks very similar for other areas, for other cities all over the world. And what I'm plotting you here is the level of rents on the vertical axis against the distance from the city center. So 0 here means you're exactly at the city center, at the city hall. And then as you move farther and farther away from the city hall, you can see that rents are starting to go down. Okay, every little cross here is a postal code, a zip code. And you see the same relationship for house prices. Okay, rents on the left-hand side, prices on the right-hand side. Now, something changed dramatically during 2020. During the pandemic, prices started to grow much more in the suburban areas than and we're falling in the urban core. So you can see this here for the New York metropolitan area. This entire area here is the New York metropolitan area. It's about 23 million people who live there. And dark green here means that house prices go up a lot. Red means house prices are falling a lot. And so this is the entire area. And basically it's clear that in the urban core, you see a lot of red, house prices are falling. In the suburbs, you see a lot of green and dark green, house prices are rising strongly. If we zoom in on the urban core, you can see here Manhattan, the island of Manhattan. You can see house prices are falling in Manhattan, they are rising in the suburbs. The same picture is true for rents. On the right panel here, you see rents, dark red, declining rents during 2020 in Manhattan, and then rising rents in the suburbs. So it turns out that you could document this pattern more systematically, and you can kind of redraw this rent or this price gradient, right? So it's the same relationship I showed you before for 2019 in green. Now in the red line, you could see the situation 1 year later at the end of 2020. And what you notice is that in the urban core, close to the urban center, rents have fallen, whereas in the suburbs, far away from the city center, rents have risen, okay? And so this relationship, this rent gradient has become flatter. That's why the title of the paper is Flattening the Curve. We're flattening not the pandemic curve that we usually talk about, but the rent gradient curve, right? It becomes much flatter. The red line is much flatter than the green line was. And the same is true for house prices on the right panel. So another way of seeing this is you can look at the changes in rents or the changes in prices between the end of 2019 and the end of 2020. And that's what this picture shows. And so you can see large declines, 20% declines in rents during 2020 in the urban core, and you can see increases in rents farther away in the suburbs. You can see the same thing for prices, although it is much more muted. You see prices are also falling in the urban core, and they're also rising strongly in the suburbs, but that relationship is a bit more muted than the relationship for rents. So one way we're going to try to visualize this change in the rent gradient is we're going to basically estimate the slope of this relationship, each month. So, imagine drawing this line here each month and then basically showing how the slope of this line changes. Okay, so that's what we're doing here. Each month, you see there's this negative sloping line. It's a downward sloping gradient, right? And then as the pandemic evolves, you can see this line become flatter and flatter and flatter. This gradient is basically going towards zero. There's a large increase in the gradient. Okay, and so that's kind of the main stylized fact that we want to document here, is that somehow the relationship between house prices and rents, and by the way, the same is true for house prices, but it's less pronounced. There's an increase in the gradient, from very negative to less negative. And so basically what we're saying is that, essentially house price appreciation in the suburbs was stronger than in the urban core. The same is true even more for rents. And so we want to understand a little bit, what that all means. So before I go into that, let me just point out that these patterns hold very broadly. I've shown you the results for New York, but they hold, in our paper, we study the largest 50 metropolitan areas, and these patterns are incredibly robust across metropolitan areas. They also continue to hold and in fact strengthen in the first half of 2021. Okay, so these patterns continue after kind of the end of our sample. By the way, they also hold in Sweden, right? So here's something very simple I did based on the data I had, and this is courtesy of my friend and co-author, Roy Investment. I looked at house prices in the suburbs, which I proxy by the prices of villas, and I look at house prices in the urban core, which I proxy by the prices of flats, okay? And so then I look at the relative price evolution of villas relative to flats in the 3 major cities in Sweden. And as you can see, basically starting from 1 in 2020, in March of 2020, you see the relative price of villas rising much faster than the price of flats, right? And so this line is going up. Villas have appreciated 12% more than flats in Göteborg, and 10% more in Stockholm, and 7% more in Malmö. Okay, so that same, I think that same price dynamic you see play out in Sweden as well. So what I want to ask next is, what did these prices and rents, why did prices and rents fall more or grow less in the urban core than in the suburbs? And I want to contrast 2 theories, 2 hypotheses. One is that it's all about commuting costs and the fact that we can now work from home and don't have to commute anymore. The second hypothesis is that it's all about the urban amenities. It's about, cities are really special because there's all these fantastic amenities there, and COVID shut down all of these amenities, and therefore, people didn't necessarily want to live in the city anymore. I'm going to argue it's the former rather than the latter hypothesis that, has the most support in the data. And then my second question is going to be, what inference can we make from the smaller changes in prices than in the rental market about the future of the rental market? Okay, so let me start by kind of thinking a little bit about the mechanism. So first, I want to show you that COVID actually indeed prompted a strong urban flight to the suburbs over this period when COVID hit, in particular between February and June of 2020. And to do that, I'm going to use some quite unique cell phone data that basically track where people are. And so we see these people based on their cell phone pings, both before and after the pandemic. And then we can basically, figure out from their locations, what their home location is, where they sleep most of the time. And, and then we can plot that relationship between the change in population and distance from the city center. And indeed, what you find is that close to the city center, the population is falling, people are leaving, and farther away from the city center, people are going. So the population is growing. You can see the same with change of address data from the Postal Service. These are people who change their address and tell the Postal Service, hey, I've moved now. And those are arguably potentially somewhat more permanent moves, because at least people go through the trouble of telling the post office that they've now moved and that their mail should be forwarded. And so what you can see so now we're just looking at out migration, people leaving. You see that there's a lot more people leaving close to the city center, and then there's then farther away from the city center. Again, consistent with this idea of urban flight out of the urban core. Interestingly, this urban flight is stronger for locations that have higher rents and higher prices. Maybe this is not that surprising. If you're living in Manhattan, it's really expensive to be there. And so, the moment that you don't have to work from there anymore, you just leave. And so that pattern holds up in the data. The urban flight is also much more strongly in locations where jobs can be done remotely, where there's a larger fraction of jobs that can be done from home. So we're going to be using this index, which I'm going to call WFH, that stands for working from home. And it basically is a measure of what fraction of jobs in that location can be done remotely. It doesn't mean that they are done remotely, but it means that they could potentially be done remotely based on the nature of that work. And there's actually a lot of variation across locations in the fraction of jobs that can be done remotely. And what's interesting is that, in areas where very few jobs can be done remotely, people are moving to those areas. Whereas in areas like Midtown Manhattan, where a lot of lawyers work and a lot of financiers work, a lot of these jobs can be done remotely. We see people leaving or at least not migrating to those areas. Okay, so a strong correlation in the raw data between working from home and changes in population. So we want to explore this a little bit more systematically in a regression framework. And in particular, we want to run a horse race between these two leading hypotheses. The first hypothesis is, it's the fact that you no longer need to work in the office, that you can work from home, that makes you not need to commute anymore. And we want to conjecture that that's the one potential driver of the changes in this rent gradient. The leading alternative hypothesis is that it's all about the amenities and the fact that there's now, amenities are now closed because of COVID. And that's the reason that people are leaving and that the rents and the prices are changing. So this amenity is going to be measured by this variable that I call stringency. Stringency is basically how stringent the local authorities were in enforcing essentially closures of bars and restaurants and all the other urban amenities that the cities have to offer. And so what I'm going to look in the cross-section of metropolitan areas, and I'm going to try to understand, the extent to which these rent gradients changed varies a lot in the cross-section of metropolitan areas. And I have about 50 metropolitan areas in the US, and I'm going to ask, are there cross-sectional associations between the changes in the rent gradient and how many of the jobs could be done remotely and how strict the local authorities were in closing down urban amenities. And basically, in a simple regression that's univariate, you can see that both of these measures show up as significant drivers of cross-sectional differences in the rent gradient. But if you put them together in a horse race, you see that the working from home effect dominates. Okay, it's the stronger of the two. Now, to get even deeper at this horse race, at this question, we're going to drill down to a smaller geographical level and look at the postal code level, at the zip code level. This has the advantage that we can control for common amenities at the metropolitan area level by including something like a metropolitan area fixed effect. And even in that area, even after we do that, we see again a strong association of working from home with changes in rent. Places where there is a lot of ability to work from home are places where people are leaving and where rents are declining. And basically a 10 percentage point increase in remote work leads to a 2 percentage point decrease in rent, which is quite strong. And the other advantage of the zip code level data is that we can have a direct measure of amenities where we can actually measure the number of bars and restaurants. Again, we do see that that's associated with changes in rents as well, but that the effect of working from home dominates. So from this analysis, we conclude that working from home seems to be the main driver of cross-sectional differences in rent growth at the metropolitan and at the zip code level. And that the role of amenities, even though it is there, appears to be less important. Okay. We also find, I did not show you these results, they are in the paper, that the role of working from home for rent changes is larger than for price changes. And I think there's something interesting about this because house prices, because they're assets, they are forward-looking. They are reflecting the present discounted value of all future rents. So the fact that these changes are smaller for prices than for rents suggests that people potentially expect some of the changes that happened during the pandemic to reverse. Okay, maybe partially reverse, but reverse. And our reading of this, and we'll try to be more formal about this, but our reading of this is that housing markets participants, by voting with their feet, by moving or not moving, by buying or by renting, are telling us that they're expecting some of this working from home to reverse in the future. Now, to get at that a little bit more formally, we're going to use a standard, very simple asset pricing framework, which is a present value relationship, which goes back to the Nobel Prize winning insight of Bob Shiller, to basically ask, what do the relative changes in prices and rents tell us about the market's expectations about future rent growth, right? And so, I don't want to spend too much time on this, but basically the price to rent ratio in a location tells us something about future rent growth, about the market's expectation about future rent growth, or about future returns. Okay, so we're going to measure what happens to the price to rent ratio in the data. We're going to make an assumption on expected future returns, and then we can back out what the market expects rental growth to be going forward. Okay, now first of all, because prices changed by less than rents, remember I showed you that rents fell close to the urban core, prices also fell, but they did not fall as much, which means that the price to rent ratio actually rises in the urban core, whereas in the suburbs, basically price and rents both increase, but they increase by the same extent, so that the price to rent ratio is basically unchanged. And so this is the change in the price to rent ratio that we're going to use. This change in the price to rent ratio, we're going to use this change to learn something about the change in the market's expectation about future rent growth. And when we do that, what we find is that because these changes in housing markets are smaller than in rental markets, and ownership markets are smaller than in rental markets, this tilting of the price to rent ratio curve basically tells us that the market expects an urban revival. The market expects rent growth in the future to be higher in the urban core than in the suburbs. Okay, so this is what I'm plotting here. I'm plotting the urban minus suburban expected future rent growth in each of the next years. So the first dot here is 2021, 2022, 2023, 2024. And so the point is that this thing is going up. The market is expecting higher urban rent growth, about 3 percentage points higher urban rent growth than suburban rent growth. And then continuing, this line comes back down, but basically urban rent growth continues to outpace suburban rent growth until eventually this process stabilizes. Now, where this process stabilizes depends crucially on your assumptions about the long run effect of the COVID pandemic. If you believe that the COVID pandemic is permanent, if you believe it's fully transitory, it's going to be the world is going to look exactly like 2019 10 years from now, then you get to the red line. Okay, that's the 50% of you who said COVID is going to be transitory. The other 50% of you said COVID is going to have permanent effects. So those of you, so that's the extreme alternative assumption, which is that, 2020, we're in a new long run, equilibrium where now the world is permanently different. And in that case, we also find higher urban than suburban rents, but now these differences are permanent. That's the blue line. Now, realistically, we are somewhere in between those two cases. And we're going to be using some survey data, just like the survey that we just did with you, but based on experts that follow the housing market in the US. And these experts have filled out the survey question that asked them exactly the same question, which is, do you believe these changes in working from home are permanent or transitory? And 2/3, 64% of the experts said, we believe these changes are transitory. 1/3 said, 36% said, we think they're permanent. So basically you can use those frequencies of answers to basically, interpolate between these two extreme scenarios to get to this orange line. And so that's kind of our favorite interpretation of the data, which is that, we expect an urban boom in rents, in the next few years. And then, it's going to fizzle out a little bit, but we're going to settle back down to a level that's a little bit higher than before. So basically, this suggests that urban rent growth is going to be permanently at least a little bit higher than what it was before. So, that's basically the conclusion of this work, which is that, our model predicts an urban revival, higher rent growth in the urban than in the suburban areas. And the more transitory the working from home shock is, the larger that initial revival and the weaker the long run effect. Okay, and and similarly, if you believe working from home is permanent, then the effect is kind of, it's going to be maybe a little bit smaller, but it's going to be instantaneous, and it's going to just occur right away and then kind of stay. So that's a little bit about my work on residential real estate. Now, as you might imagine, there's lots of important implications for commercial real estate and prices and rents in the pandemic as well. And so this is based on some initial, the rest of my talk is going to be somewhat more preliminary in nature, since this is something that I'm, very much in the middle of working on. And we're going to be thinking about commercial real estate, meaning, income producing real estate. And just some casual, empiricism, casual observations suggest that different real estate sectors have been impacted, commercial real estate sectors have been impacted very differently. So I like to think of this in terms of a traffic light analogy: red, yellow or orange, and green, right? So red is, you're very severely negatively impacted by COVID. Orange is you're in the danger zone, and green is, you're doing great. COVID actually enhanced and boosted your prospects. So like you said in the poll, hospitality, is very severely negatively impacted to this day, especially on the business travel side. There's a lot of, conference space, hotel space for business travelers, and then of course also business airline, revenue shortfalls. Experts expect travel not to return to 2019 levels until 2025. Leisure travel is likely to come back sooner than business travel. But clearly there's potential danger here. Some of these hotel properties are being converted into apartments in New York City. Sometimes they're being converted in homeless shelters. But obviously there's a limit to how much of that type of conversion is profitable and is useful. Retail is another one of these big negatively affected sectors with the e-commerce. E-commerce was well underway before COVID. And the decline in brick and mortar retail real estate, shopping malls, and so forth started well before COVID, but COVID has accelerated the adoption of e-commerce by at least 5 years. Now, it's not all doom and gloom. If you're a grocery store and you're in a grocery strip center or mall, you're doing a lot better than if you're in a pure retail, clothing store, shopping mall. And again, there's some conversions of mall properties into industrial warehouses, sometimes into senior housing complexes. But that conversion is not frictionless. It usually means somebody needs to take a big loss for that conversion to make economic sense. Office is what I want to spend quite a bit of time on, so let me skip this here. But again, it's not, I think office is in the orange category of, being in the danger zone. And I think we need to distinguish between urban and suburban office, kind of along the same lines of urban versus suburban retail, residential. Apartments, I think, again, are a tale of two halves. Urban gateway apartments, have not done very well in the pandemic. Suburban secondary markets have done quite well. And then industrial real estate, warehouses, think about an Amazon.com warehouse or those have done phenomenally well. They have benefited from e-commerce. It's kind of the flip side of retail. So as bad as retail has done, as well industrial has done, it's really one of the strongest commercial real estate sectors, and it's really trading at all-time record valuations right now. And then similarly, these are niche real estate sectors, but that have also done very well. Data centers, cell phone towers, life sciences. So like laboratory space, for example, has done very well with the rise of pharmaceuticals. So next, I want to drill down a little bit more deeply into the office market, because I think the office market, like all of you said in the poll, is in some sense the most interesting and the most vulnerable sector to disruptions of working from home. And also there's enormous value attached to office spaces. Think about the value of all office space in downtown Stockholm. Think about the value of all office space in downtown London or in Manhattan. We're talking about hundreds of billions of dollars worth of real estate. And so if there's a major change in our patterns of working from home, it's going to have major valuation effects. You can think about all kinds of spillovers to the banking sector. Banks have made a lot of loans against office space. Some of these loans have ended up in the securitization market. So there's a lot of potential spillovers to worry about. So here's a fact about office occupancy. And by occupancy, I mean physical occupancy. How many people were actually in the building? Well, it turns out a lot of office occupation is basically by college educated. And something like 70% of all the college educated did some or all of their work from home during the pandemic. As a result, physical occupancy fell from something close to 100% to 15% in March and May. Okay, so 85% of the people were not in their office. And since then, it's been this is for the largest 10 metropolitan areas in the US. Since then, it's been a very slow recovery. And even a few weeks ago, only 40% of people were back in their office in the US. In New York City, it's even worse. It's only 23% of people are actually back in their office. Okay, and that's after a little bump here after, in September when the school year started. Now, that of course seems like a horrible number. Only 23% of people are actually in their office. Now, of course, it's not because you're not in your office that you're not paying rent, right? So a fact that you need to know about the office leasing market, the rental market for office space, is that people sign long-term leases. And so a lot of leases are not up for renewal. And so as a result, if you're a company and you've signed a 5-year lease or a 10-year lease that expires in 2027, even if you're not in your office, even if your employees are working from home, chances are you're still paying your rent because your contract, you're contractually obligated to pay your rent. So what I'm doing here is I'm using a large data set of lease level data for the United States, which is a new data set, as a little bit underexplored for research, that allows me to look in great detail at, for example, the maturity structure of these leases. Okay, and so what I'm showing you here is all the leases that were outstanding at the end of December 2019. When do they expire? When does the lease come up for renewal? And as you can see, it's kind of like, spread out. 20% of leases expired in 2020, another 17% in 2021, and then so forth. And then a lot of these leases expire not until 2026 or later. And basically, a lot of the high quality tenants, they just continued to pay their rent, even though they were not physically using their building. But obviously, at some point, their lease will come up for renewal. So this is like I think of this as like a train wreck in slow motion. It's going to take 5 or 6 years before the full shakeout from the COVID pandemic is going to really be revealed because this lease expiration schedule. So, despite what I just said, and despite the fact that there's still a lot of people paying their rent, 20% of leases did come up for renewal in the last year and a half. And a lot of these tenants decided not to renew or to renew and take less space. So as a result, the vacancy rate of office, which is actually how much is actually contractually vacant, has been rising. And it's been rising in the US kind of as a whole. You can see this, spike here at the end of the sample. And you can see this, here from a picture from The Economist in New York City. In New York City, meanwhile, this picture is kind of out of date. In Manhattan right now, the office vacancy rate is 18.3%, which is the highest number it has been in 30 years, since 1994. And similarly, in London, vacancy rates are spiking up as well. So vacancy is a problem already, and it's going to continue to be a problem as more leases roll off. Now, one thing we look at is, are people actually, are they actually signing new leases or not when their lease comes up? And so this shows you the number of new leases from that same data set, CompStack, that has been signed per year. And I'm showing you a 6-month moving average. In the left picture, I'm showing you the number of new leases. In the right picture, I'm showing you the square meters or the square feet of new leases signed. And it's obvious that there's a massive drop off in new lease activity. Okay, so companies are very reluctant to sign new leases. New leasing activity is about half, or even less than half, than what it was before the pandemic. So a massive decline in leasing activity. This decline in leasing activity is about equally large for major markets and for the secondary cities. And what we then do is we ask, what is the probability that somebody whose lease comes up for renewal will actually sign a new lease? And we make that, we try to model that as a function of, what kind of tenant is this? What kind of space are they renting? What is the location of the building? So we model that probability, that lease renewal probability, as a function of tenant characteristics, building characteristics, and lease characteristics. And what you can see in our data set here is that essentially there has been a 50%, if not more, decline in the probability that a tenant, that the same tenant basically over time, this is basically what we're doing here is we're tracking the same tenant over time, if you like. That same tenant, their probability of renewing goes from 20% to about 9%. Okay, so it falls by more than 50% in the pandemic. Okay, so that's obviously a major change in that lease renewal probability. Once we've estimated that lease renewal probability, we could do counterfactuals. We can ask hypothetical questions. We can say, well, take technology companies, for example. Okay, so there's a lot of talk about Google and Facebook doing really well and they're signing new leases. Well, we can investigate that more systematically. And so what we're looking here in the left picture at is, what is the lease renewal probability of a tech tenant? And the blue bar is the tech tenant had to renew their lease at the end of 2019. How likely are they to renew? Well, they're about 20% likely to renew in that same building. And then the orange bar is, now take a tech tenant 1 year later at the end of 2020, how likely are they to renew? Well, they're about only half as likely to renew, only 10%. And so now we can ask an interesting counterfactual question. We can ask, what if that same tech tenant who actually came up for renewal at the end of 2020 had come up for renewal at the end of 2019? So that's that orange bar here on the right. That's basically saying, Facebook had a lease come due. What would have happened if that same lease had come due a year before? Well, the answer is, it would have been almost twice as likely to have been renewed. Instead of 10%, it would have been a 20% renewal probability. And now we can compare this to non-tech tenants. And you see the changes are actually much larger for tech tenants than for non-tech tenants. So despite the fact that the technology sector is doing phenomenally well right now in this modern economy, they're actually, maybe not surprisingly, because they can do work from home so easily, they're actually making big changes in their office use, much more than non-tech tenants. Okay. We can look at companies that can, that have employees that can do their job remotely, high working from home from low working from home. Again, we see a much stronger drop off, or alternatively, a much stronger counterfactual, decline in lease renewals for high versus low working from home companies. We see a lot of geographic differences. Texas, for example, is doing very well relative to the rest of the US. And so we see that the lease renewal probabilities, drop in Texas, but not as much as before. Not as much as elsewhere. And then finally, we see that, newer buildings, are doing better in general than older buildings. And they're seeing a smaller drop off in renewals, but still there is a substantial decline in renewals in newer buildings. Finally, you can look at the quality of the building. We see higher renewals for the highest quality office buildings, but similar drop-offs in the pandemic. Now, even if a tenant renews, the next question is, what kind of lease are they signing? And what we're finding is that tenants are signing much shorter term leases than they used to. So the blue line is here of all the new leases that are being signed in a particular period, what's the share of those leases that are only 3 years or less in duration? The orange line is what is the share that are very long-term, more than 7 years in duration. And you see this huge bifurcation here at the end of our sample, where after the pandemic, even if they renew, the tenants are much more likely to sign short-term leases. So they're basically kicking the can down the road. They're basically saying, okay, for the time being, let's just sign a new lease. Maybe we take less space, but definitely let's sign a short-term lease, because we don't know how working from home is going to play out, and we want to have flexibility for what's going to happen. Who knows? Maybe 3 years from now, we're 100% clear that we can be productive and our employees can make just as much money, be just as productive working from home, and we don't need this office space anymore. And now that we've only locked ourselves in for a 3-year lease, that's less painful than if we locked ourselves in with a 7-year lease. Next, I'm looking at rents, right? So obviously we're very interested in rents. What are the cash flows on these buildings going to look like going forward? And I'm plotting rents both in nominal terms and in real terms, meaning inflation adjusted, right? So the bottom lines here are inflation adjusted rents. The top lines here are nominal rents. Let's just look at the nominal rents. Nominal rents have already fallen something like 21% and 21.5%. In real terms, 24.5%. So that's a substantial decline in rents. This decline in rents, has some composition effects, where you could take those out and you still essentially find very similar results. So rents have fallen already, kind of despite the fact that a lot of this office space has not come up for renewal yet. All of the decline in rents is concentrated in these major markets, in the largest cities. The secondary markets, I've actually not seen any decline in rents whatsoever. So it's a bit reminiscent of our discussion of urban versus suburban. In the office market, it's a story of large cities like New York, San Francisco, Boston, Washington, DC, have seen large declines in rents. Everywhere else, the secondary cities, Arlet, Denver, Nashville, those type of places do well. Companies are relocating there. Miami is another example that is in the news a lot. And so there we don't see any declines in the rents yet. And then, next I want to turn to the asset markets. Okay, so now I want to look at people selling entire office buildings. Okay, and so the question, why do we want to look at prices? Well, just like the way we looked at rents and prices for the residential market, we want to look at rents and prices for the office market, because the office prices are forward-looking. They're telling us something about the market's expectation, not only of rents in the short term, but of the entire future path of rents. And actually, in the pandemic, there were very few office transactions. The market for office sales basically dried up. There were a few. And now that market is actually rebounding quite strongly. So now there's a lot more office transactions. What we can see in the prices is we see that office prices have actually fallen in the central business districts, in the urban areas, by about 13% since the end of 2018, by about 11% since the end of 2019. So we also see, just like we're seeing rental declines, we're seeing somewhat smaller price declines. It's actually a very similar picture from what we saw in the residential market. Both rents and prices are falling. They're falling more in the urban markets than in the suburban markets, and prices are falling by less than rents, suggesting that the asset markets are foreseeing some sort of reversal, some sort of urban revival in the future. Okay, you can also look at the stock market. Okay, some of these office companies are publicly listed, and the beauty of the stock market is very quick to incorporate any new information. And so you see right in the pandemic, between February 13th and March 20th in 2020, you see these office REITs. So these are these publicly listed office companies. You see the stock prices of these REITs fall dramatically, like 50%, a little bit more for the major markets than for the non-major markets. And then you see these REITs have a strong recovery since then. Okay, so one thing we can do is use a similar Campbell-Schiller type valuation framework, like we did in the residential market, to basically ask, how can we explain these large declines in valuation ratios, these large declines in the price dividend ratio of these office companies? And the declines were large indeed. In the left panel, I'm showing you the price dividend ratio on office REITs, and you could see it falls about 47% from December 2019 to September 2020. And then there's this major recovery in the office markets, in the stock market for office companies. From September 2020 to July 2021, we see a 42% rebound. And so now the question is, why is that? I call this whiplash, okay? A huge sell-off and then a huge recovery. So why do we see this? Well, in asset pricing research, there's broadly speaking only two possibilities. When you see prices fall or price valuation ratios fall, either it has to be that people expect cash flows to go down for the foreseeable future, or because risk premia rise. So when we do this decomposition, what we find is in that initial period from December 2019 to September 2020, it's all risk premium. All of it is explained by a huge increase in risk premium. None of it is cash flows. If we look at the recovery from September 2020 to July 2021, it's very different story. It's 2/3 of it is cash flow growth expectations. The market is rebounding because companies are revising. The market is revising its expectations of future cash flow growth, of future rent growth on these office buildings, if you like. And some of it is a decline in risk premium. Okay, but most of it is coming from expected dividend growth. You can see this here in the right panel here. You see expected dividend growth is high, it's rising. And so the market expects higher future cash flow growth on these office buildings basically going forward. Now, this actually did peak a little bit in, a few months ago, and it has been coming back down. So the market is becoming maybe a little bit more pessimistic in the last few months, but still it's much higher. It's much more optimistic than it was, at the end of, in September of 2020, before we had the vaccine distributed. So I conclude from this that the REIT market is bullish, has bullish cash flow growth expectations going forward. We also see this in analyst data. I want to skip this in the interest of time, but when we look at some analyst data of these same office REIT companies, we see that the analysts have kind of revised down their cash flow growth expectations in levels, but that they're forecasting a higher growth rate on these cash flows. And in particular, that these REIT analysts also do not seem overly worried about the long-run decline in cash flows on these office REITs. So that's what I wanted to share with you on the office market. So now let me finish up in my last couple of minutes with some broader thoughts, some speculative thoughts on the future of cities. Okay, and this is obviously going to be closely related to what we talked about until now. So, all of this, I think the rebound of both the apartment market in the urban core as well as the office market in the urban core, in my mind, crucially relies on what happens to remote work in the next several years. And there's been, a lot of interesting evidence that has slowly come up. A lot of it is based on surveys that suggests that a lot of this remote work is here to stay. Barrera, Bloom, and Davis predict a 4-fold increase in remote work. A lot of CEOs believe that remote work will be here to stay. I'm citing some survey evidence here. A lot of employees also want to work remotely, and this is the first question you answered today. Like, do you think you're going to be working remotely in the future? And interestingly, there's differences of opinion between employers and employees. The employees actually want to work on average 1 day more per week than the employers want them to, right? So think of it as the employers think that we're going to have 2 days per week remote. The employees want to work 3 days per week remote. A lot of employees want to work some of their time remotely, 96%. And so remember, we are in a very tight labor market here. And so employees are holding the cards. And I think that's an important fact when we think about the future of remote work. As long as the labor market is as tight as it is today, it's the employees who are going to dictate, I think, remote work practices, because otherwise they're just going to leave and they're going to go somewhere else to another company that allows them to work, more days per week remotely. And already many firms have instituted permanent remote work opportunities, and many others have instituted permanent hybrid options. I'm just giving you some examples here. Okay, McKinsey estimates that 22% of all work in the US can be done remotely for 3 to 5 days per week without any loss of productivity. That's the black bars here in the plot, especially in sectors like finance and insurance or management. And an additional 17% of work can be done remotely 1 to 2 days per week. Those are the blue areas here, again, without any loss of productivity. So, and I think a lot of companies are finding this out as they go through this. Now, there's a lot of interesting heterogeneity here, though, because women and men are different, and especially education. There's a lot of differences in remote work by education. High school graduates, think about this for a second. Among people who have a college degree or better, 70% of them essentially are working remotely during the pandemic. Among people who don't have a college degree, so high school graduates or worse, 70% of them did none of their work remotely. Okay, so I think of this remote work as an important component of our discussion on inequality in the quality of life, for example. If you have to commute, if you have a long commute every day, that lowers your quality of life. Well, it's the low income, low educated people who are going to have to do more of that than the college educated. So that's an interesting observation, I think, as well. Finally, I think there's important tax implications, and those are really important for the health of cities, especially in the US, where a lot of local amenities are paid for with local taxes. Things like police, public transportation are often funded locally, and property taxes are a very important part of the tax base for these local municipalities. So just to give you an example for New York City already in the current tax year is losing $850 million in tax revenues just from property taxes. And it's because, basically these office buildings in New York City are now worth 16% worth less. The office sector property taxes bring in about $7 billion per year for New York City. So just from these from this decline in valuation, New York City is losing $850 million from a decline in property taxes just from the office buildings. There's an additional $850 million in tax loss from other real estate. And then there's additional tax loss revenues from retail, from sales taxes. Retail properties are also doing very poorly in Manhattan. And then if the rich people leave, then they don't pay local income tax anymore. So all of these things are really putting a huge crush on the local public finances. And so this risks turning into a 1970s style downward spiral. In the 1970s, New York City was a terrible place to be. The Bronx was burning. Tax revenues were low, people were fleeing the city, and because of that, there was less tax revenue, the amenities were getting worse, public transportation was getting worse, safety was getting worse, more people were leaving, and so forth. And so you get into this vicious cycle of lower amenities, lower tax revenue. And the risk is that we're getting into a cycle like this. And so that is the risk. I'm not saying this will happen, but I think because of this connection between property taxes and property values, because between tax revenues and property values is, I think, a very important thing to think about. Now, I do think there are two potential tailwinds, long-term tailwinds for the city. The tailwinds for the city is that there's just a secular growth, a trend in office using employment. Think about the growth in the tech sector, and that's going to be good for cities because to the extent that they want some offices, that's going to be an increase in demand for office space. And then there's something that's a little more subtle, but I think also a very interesting possibility, which is there's this view out there that the large cities were too small. So places like London or New York City, or maybe even Stockholm, were too small before the pandemic. Why were they too small? Because it was so bloody expensive to live there. And so companies didn't go there because they knew that their employees couldn't afford to live there. Now with working from home, this calculation changes because now you're a company and you say, fine, I'm going to go to Stockholm because my employees do not have to live in the city center anymore. Why not? Because I'm going to allow them to work from home 3 days per week or 4 days per week. And there's some examples of this anecdotal evidence. For example, Rite Aid moved its headquarters from the suburbs to downtown Philadelphia with this idea that, we don't need everybody to be in this office every day anymore. Our headquarters is now a creative meeting space because we've become a remote first firm. And so if that's true, if that turns out to be a big thing, that could be a tailwind for the large urban centers as well. So I'm just about out of time. So let me wrap up with the following conclusions. Working from home has and will continue to reshape where we live and work. The genie is out of the bottle. We cannot put it back. Everybody who believes that we can just go back to life in 2019, and believe me, there's a lot of people working in the office sector who believe that. Maybe they want to believe that. They are going to be in for a rude awakening. Short and medium run, I foresee a lot of headwinds for the office sector because of all the facts that I gave you: low office occupancy, high vacancy rates, low lease renewals, falling rents, shorter contracts, falling prices, falling tax revenue, safety concerns. In the long run, I do see some tailwinds. There is a glimmer of hope, and the glimmer of hope is just secular growth in office sector employment and increased business relocation to the major urban centers. Now, which of these two forces is going to dominate in the long run? I think nobody knows. It will depend on how productive we can be in the long run working from home. But importantly, it will also depend on the policy choices that we make. So this is not predestined. We and in particular our local policymakers are going to decide in which of these worlds we're going to live. It's going to depend on tax policies in urban centers. Are you trying to bring residents back? Are you trying to bring businesses back by being business friendly? Are you going to improve your urban infrastructure, your public transportation infrastructure in the long run? Are we going to have driverless cars? What's going to be the regulation of driverless cars? And then finally, there's an important intersection with environmental concerns. We know that people driving to the suburbs, that's just very bad for the environment. Also, a lot of suburban living has much higher carbon footprints than urban living. The best way for us to solve our carbon problem in terms of how we live is high density urban living. That has the lowest carbon footprint. And so I think it's in our best interest as a society that is really worried about environmental concerns to try to bring people back to the cities, but that's going to depend on policy choices. Okay, so let me stop here, and happy to take some questions. And again, I want to thank the committee for recognizing us with this award. Thank you so much.
All right, thank you very much, Stijn. We do have a few questions in the Q&A box, and I will read them up for you, Stijn, and you can elaborate on them if you would like to. We promised to stop in 5:45, so that's sort of really the end time. But in the beginning, when you talked about prices and rents and the flattening of the curve, there was a question about how do we think about vacancy rates in relationship to the prices and rents?
Yeah, so that's a good question. It turns out there's also interesting facts that consistent with this in the on quantities. So in particular, the vacancy rate in residential markets, we usually talk about the inventory of houses for sale, right? And so the inventory of houses for sale, as you might imagine, dropped dramatically in the suburbs and rose dramatically in the urban areas. So it's not just that the prices and the rent changed, the amount of houses for sale also changed, the quantities also changed, and in ways that are consistent with what you would expect. And similarly, another metric of housing market liquidity is how long are houses on the market before they sell, time to sale. And then again, we saw sharp reductions in time to sale in the suburban markets, and we saw sharp increases in time to sale in the urban market. So I think all of that is very consistent with the story, and it's a good point that this shows up in both quantities and prices.
All right, thank you. One of the things that you, it seems like when you discussed the first part of the evidence, that it was very much demand driven, so to speak. How do you think about the supply? This was one of the questions that came up in the Q&A box.
It's an excellent question. And I think the focus on demand is justified in the short run because supply cannot adjust in the short run, right? It takes a while to build a new home. It takes a long time to build a new apartment building in the city center. A lot of that is because of regulation. Just you need to get permits to build. So that takes forever, not forever, that takes a while. And so I think short run, I think it's essentially the elasticity of supply is zero. Now in the long run, that's obviously a different story. And I think you can already see right now in the data that there's a strong supply response, a huge construction boom underway in the suburbs. So, new single family homes are being built, new homes for rent, single family homes for rent are being built. There's a huge boom going on in what's called the single family rental sector in the US right now. And so you could see that very strongly. So there will be supply coming online, and it will alleviate some of the price pressure in the rental market and in the housing market in the suburbs.
Thank you. Another thing that came up in the Q&A box was about the moving from cities and suburban location. And we had a poll, and 15% said that they were considering or had moved recently. What about the demographics there? You can imagine that this will be different among young people and old people and maybe families and so on. And what are the effects on the real estate market?
Indeed, there is, I think, right during the pandemic, I think there was a kind of a panic migration where essentially everybody who could left. And that was across the demographical spectrum, across the age spectrum. A lot of young people left because they often moved back in with their parents, for example, or they rented a house with some friends in the suburbs and shared the cost of that. But like you said, a lot of families fled as well. That's correlated with schools, being closed at that time. And for a lot of people, what this ended up doing is accelerating a move that they might have made to the suburbs anyways a few years later. So there's a lot of anecdotal evidence that, people in their 30s that, have one or two small children still live in the city center. They might have moved out anyways, but COVID is what pushed them over the edge. And now they're like, okay, let's move now. Let's buy our suburban home, and we're not coming back. You see the young people coming back now to the city centers. And you don't see the people who bought single family homes with children come back because their children are now in schools in the suburbs and so forth. And so that is clearly a permanent move. So I think that's roughly how it shakes out across the age spectrum.
Thank you. In the second part, you talked a lot about the offices, and you mentioned the sort of the vacancy rates that were record high and so forth. But how are transactions done now in the real estate market? Who is buying, who is selling, and can you say something about that?
Right. So there were very few office transactions in 2020. There were some. There was also, and I think both residential and commercial real estate markets are interesting and different from, let's say, the stock market, because normally in the stock market, in bad times, we have a lot of volume, we have a lot of trade, because we have a lot of disagreement about what the true value of the stock is. In real estate markets, we see the opposite. In bad times, we have little volume, we have little sales. And the reason often that people think about, there's two reasons for that. One is that people don't want to sell for a loss if they don't have to, right? So you bought an office building, you thought it was worth 10 million, now, or 100 million krona. Now, the market, if you sold it today in 2020, the market would give you 50 for it instead of 100. And you say, well, I'm not going to sell at such a huge loss. So as a result, there's very little sales activity. As a result, we see very few transactions in real estate. So a notion of loss aversion. Also, oftentimes these properties are levered. And so oftentimes you cannot afford to sell at that low price because it's not enough to repay your mortgage, your commercial mortgage. So that's why sales volume is so low. So it's a little hard to say who is buying, who's selling if there's little activity. There's always some people who have contrarian views that the office market will rebound. A lot of there's anecdotal evidence that some of the office REITs have bought last year because they see these depressed prices and they feel that it's a great opportunity to buy because they're fundamentally strong believers in the city. They will tell you stories like, the urban city always comes back. It always has, if you look over the course of history, we've had plagues before in the Middle Ages in Europe, and urban centers have thrived, maybe not immediately after, but in the long run. And so there's clear believers. There is heterogeneity in opinion, difference of opinion in the future of remote work. Whether we ultimately can be innovative and productive and have good corporate culture if we all work from home. And there's some people who say we cannot, we will have to go back. And so I'd rather buy the office now when prices are 15% lower than wait until they rebound. So I think that is there's also some money from sovereign wealth funds that has flown into the asset class, especially from the Middle East. So there's some anecdotal evidence, but it's anecdotal because there's so few transactions that took place in office.
Yeah. So the final question is a very broad question related to say what are the effects coming from the real estate market into salaries, for example. If I move out, I don't need to sort of commute to Stockholm City. I don't need to buy an expensive apartment in Stockholm, etc., etc. Have you thought about what will be the effects on salaries?
This is a very good question. And I think my view on this is that it will change the salary structure, and that because companies, at least in a competitive labor market, will not be willing to pay, downtown centered wages for people who don't live there. And I think some companies have already come out and said that. They have said, you can work remotely and you can live somewhere in a cheaper area, but then we're going to pay you a salary that's commensurate to the cost of living in that area. Now, if you think about that for a second, you realize that, if your job can be done remotely, it can also be done from India. It can also be done from, places where the salaries are dramatically lower. And so I think there's, a potentially hugely disruptive force here for labor income. And so a lot will depend on, do you actually still have to live in the metropolitan area? Do you still have to be able to come in, for example, one day per week? Or can your job be fully done remotely? I think the jobs that can be done fully remotely without loss of productivity, they might go to India, or I mean, just as an example, to a low-wage country instead, or at least a low-wage country with the same, where they can hire the same kind of skill set. The jobs where you still need to live in the metropolitan area, I expect some sort of adjustment of the salary that's much more modest, but that still reflects the lower cost of living of those suburban locations. I think ultimately, we're in a very tight labor market right now. So right now, I think this is not an issue. Salaries are rising, and they're rising strongly right now. But I think longer run, this will reshape how we pay, how companies pay people.
All right, thank you very much then. This has been a super interesting talk. I would like to again congratulate you to the award. I would like to thank all the participants and for asking questions in the Q&A. And I just want to conclude by saying what an interesting line of research that you have, and we look forward to see more. Thank you very much.
Thank you so much, Magnus, and thank you again to the committee.